What's going on YouTube? It's Mr. Kingdom Cash, Charles Dyson here. Shout out to the whole Retired in 365 family, the Kingdom Cash trading squad. And what you're about to see is a training that I did for a small intimate group within the Kingdom Cash trading squad. You're gonna see really me break down risk management and some tips with trading psychology that really helped me out. And I wanted to spread the knowledge, which is why I posted this publicly on YouTube for you guys to view, and also for specifically the Retired in 365 family. So all you guys, make sure you watch this video, you take this information, and you apply it to your psychology when it comes to trading. I'm just gonna let the video do all the talking, and I appreciate you guys for watching. All right, y'all, we're recording now. So what's going on, fam? All right, so Carla, yeah, the cloud is dope. I know the cloud is all that. All right, so check this out, y'all. What I'm gonna do right now is I'm gonna get into risk management, because I think it's very, very, very important that you guys understand, how to properly protect your account. And we're just going to bounce around. I'm going to go over several different things that you guys need to understand in order to successfully protect your account and grow your account and stay safe in the market, because I think this is extremely important for your growth and for your development to, not be out here blowing accounts and doing things the wrong way. I want you guys to do things the right way. So I think it was important. I was thinking about what we could talk about today and what we could discuss and what I can show you guys. And I think risk management is going to be definitely extremely important for you guys' success. So what I'm going to do is I'm actually going to share my screen, and I'm going to go over the math when it comes to, how to decide what your risk management should be for the trades that you take. I'm going to go through the math that I literally do myself, and you guys can take it and adjust it for your particular accounts. All right. And definitely use this information. Please use this information. All right. So let's go over some risk management stuff, y'all. All right. So first off, trading is not gambling. All right. Trading is not gambling. And what I need you guys to understand is your confidence is going to be your biggest ally when you're trading. Your confidence. And this is, of course, for those people who are doing their own analysis. If you're using the products, if you're using the harmonic scanner, if you're using swipe trades, just take the trade, y'all. Just take the trade and use correct risk management, which is what we're going to go over. But when you are doing your own analysis, if you are not confident with what you are seeing in the market, then you should not be jumping into the trade. I hope y'all understand that. If you are not confident, if you're guessing, then you need to train more. If you're guessing about which way the market is going to go, then you need to train more, because when you're guessing, you're gambling. But trading is literally a skill set. It's the ability to look at the charts and understand what's going on, and then making a determination or looking for confirmation that what you believe is going on is actually going on. And then you take the trade. And I'm going to talk about that in a couple of minutes. But I wanted to start off like that. All right, so let's say you have a $100 account. Let's just start with a low number. Then how much risk should you be using in your trades right off the bat? All right, so at no one time should you be risking greater than 5% of your account. All right. 3% if you want to stay really safe. Okay? So how do you do the math on that? If you have a $100 account, then what is 5% of $100? So 100 times 0.05. All right, that's how you do percents. You take the 5, you move the decimal over twice, and that's how you multiply percents. So this is important. This is basic math. You don't even have to do it in your head, okay? 100 times 0.05 is $5. All right, so if you wanted to stay within 5% of your account, you never want to lose more than 5% of your account at any one time, okay? So what does that mean? That means that you should be staying with a 0.01 lot size, okay? When you have a $100 account, if you want to stay safe. Why am I saying that? Because $5, 10 cents a pip, 10 cents a pip, how much is that? Times 0.10. All right, so that would be, so let's do it like this. Basically 50 pips times 0.10, which would be 10 cents a pip, is $5. I did the math wrong. 5 divided by, okay, so basically 5 divided by 10 cents per pip is 50 pips. Okay, so if you wanted to stay safe, you could risk 50 pips on one trade at 10 cents a pip. And if you lost the trade, you would lose only 5% of your account at one time. But you can split that risk up between two different trades. You can split that risk up between two different trades. So it doesn't have to be all in one trade, but I'm just giving you the maximum amount of pips that you can risk at one time to stay within 5% of your account with a 0.01 lot size. That makes sense? So if we did two trades at $2.50 or $2.50 maximum loss, max loss, all right, in two different trades, right? Then everything just gets divided in half. Still using a 10-cent lot size, then it would be 25 pips. You can have two trades open at one time with 25 pips available for you to lose. I hope y'all follow me. So $2.50 divided by 10 cents per pip, 25 pips. 25 pips. So all I did was take this, divide it in half, take this, divide it in half, to make my risk for two separate trades add up to $5 if we're going based on 5% of the account. Now let's talk about 3% if you want to stay really, really safe. Obviously the answer would be $3. I'm just doing a calculator for you guys so you can see and get used to the math. $3. Okay? So that means at any one time, if you wanted to stay below 3% risk to stay really safe on your account, you will never risk more than $3 at one given time. So What if we used 0.2 lot size? Well, $3 divided by 0.20, which is 20 cents per pip. Just so you can see it, 3 times 0.20. Hold on. 3 divided by 0.20. 15 pips. 15 pips. My phone is dying and I don't have any chargers, so I can. That's cool. That's all right. 15 pips. All right. So what does that mean? That means if I wanted to use a higher lot size, then I have 15 pips of breathing room to stay within my $3. 15 pips is not a lot of pips for a stop loss, so you have to be very, very confident in order to do that, right? But if we did a 10-cent lot size and still stayed within our $3, oops, 3 divided by 0.10. Now you have a 30 pip stop loss. Way better. Now, my philosophy is a 1-to-3 risk to reward ratio. I will not take a trade unless I can get 3 times the amount of pips out of the trade that I'm risking to lose. So if my stop loss is 30 pips, then that means I want my take profit to be 90 pips, because 30 times 3 is 90 pips. So if I was doing analysis and I wanted to get 90 pips out of a trade, then that's swing trading. I'm doing my analysis off the weekly, off the daily, off the 4-hour, and I'm entering my trade off the 1-hour. Okay? So I'm doing my analysis on the higher time frames, and I'm looking for a trade that I can put a 30 pip stop loss with a 90 pip take profit at least. That makes sense. This is how you stay safe with your $100. Because guys, if I lose the $3, am I mad? No, I'm not mad at all. But if I'm using proper risk management, then if my risk in that one trade is $3, then my reward is $9. Because I'm doing 1-to-3 risk to reward. My risk is 3, so 3 times 3 is 9. So if I'm risking $3, I have the potential to make $9, which means by the end of the trade, I have $109. Okay. Now, as your account gets bigger, let's talk about that. As your account gets bigger, let's say you have a $500 account. You have more cushion, right? You have more cushion. 5%, 5% of 500 is what? Let's do the math. So we're gonna do 500 multiplied by 0.05 is $25. So if I wanted to stay safe, $25 is all I'm risking maximum out of this $500 account at one time. So if I'm in 2 trades, 3 trades, the total amount that I can lose in those 2, 3 trades is $25. That's the maximum amount that I'm willing to lose out of this account at any one time. right? If my trade account is $1,000, all right, let's do the math on that. What's 5% of $1,000? Let's do it on the calculator. 1,000 multiplied by 0.05. That's $50. At any one time, I'm not trying to lose more than $50 out of this account with all the trades I'm in. If I'm in 4 trades, 5 trades, 3 trades, it does not matter. I'm not going to lose more than $50 at any one time when I'm trading this account, this $1,000 account. What if I take it to the $1,200? If I want to stay safe, I can keep my risk the same. I'm still not going to risk more than $50. What if I grow it to $1,500? I can still stay safe. I'm still not going to lose more than $50. What if I take it to $1,800? Okay, I'm just growing my account $800. That's adjusted risk. That's adjusted risk. 1,800. 1,800 times 0.05. Now I can lose at any one time $90 of the account. So I can increase my lot size a little bit and keep the same amount of trades I'm taking, or I can keep my lot size the same and be in more trades that amount to a maximum of $90 that I lose at any one time. Everybody following me? Does this make sense? If I lower it to 3%, the lower the amount, the lower the percentage, the safer you are. The lower the percentage, the safer you are. $54 max out of 3% of this $1,800, right? But here's the thing. Awesome. So here's the thing. Here's what I need you guys to understand about trading, because everybody wants to get to the $1,000 days, right? Everybody wants to get to the $1,000 days. Everybody wants to get to the $500 days, right? But I want to make you guys aware of something. So I pulled up the calendar. All right, I pulled up the calendar. This is September. Now, let's just say the market is closed on Saturday, of course. Let's just say you do not trade Sundays. You do not trade Sundays. You do not trade major American holidays, and you do not trade NFP. Let's take October for an example. You do not trade NFP. All right. So we got 1, 2, 3, 4 weeks, and then a half a week here. All right. So we don't trade holidays, so we're not going to trade Columbus Day. That means you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 trading holidays. We won't trade Halloween. Let's just say 20 trading holidays, because we're not going to trade the first Friday. That's NFP. So we got 20 trading days. I want you guys to understand something about trading. It's all about being profitable. It's all about being profitable. If you have 20 trading days and you just made $20 a day, how much money would you have made? Right? You would have made $400 in a month. You would have made $400 in a month. Are you a loser if you only make $400 in a month? And this is just $20 a day. This is just $20 a day. Guys, you can make $20 literally in 20 minutes. That's 20 pips on a $1 per pip. That's 40 pips on 50 cents a pip. I'm trying to shift your mindset a little bit to understand that it's about being profitable. $400, that's a car note. That's a water bill. That's a gas bill. That's your IML monthly fee plus a gas bill, a water bill, or a car note. Do y'all understand what I'm saying? It's about being profitable. It's about being profitable. And I think it's important that we paint this picture very clearly, because $20 a day, everybody on this webinar right now can do $20 in their sleep. What we do is we overtrade and we give the money back. So that leads me to my next thing. My next point is this: trade with a purpose. Don't just trade to trade. Trade with a purpose. Why are you in the market? What are you trying to accomplish this month? What are you trying to do? What is your goal? Right? And when I say trade with a purpose, I mean a PIP goal or a money goal. Okay? Now, do not chase the money. Chase the pips. Right? That sounds like an oxymoron, right? That sounds like I'm double talking. I'm not. You do not chase money in the sense of, oh, I need $1,000 a day or bust. That's the wrong mentality. That's the wrong mentality. Oren Wright, great educator on IML Academy. Oren said originally his goal was just, let me try to cover the water bill. Average person's water bill on this webinar is anywhere between $60 and $90 a month. Right? The water bill. What if you can knock that off? Right? His goal was, let me see if I can knock off the water bill and have it come out of my trade account instead of out of my job money. Then he said, oh, okay, I did the water bill. Let me try to get the gas bill done before the end of the month. Did that. Okay, all right. Let me try to do the car note. See, but what you got to do, let's just say the water bill, let's round it off. Let's say the water bill is $75, right? Let's say the water bill is $75. You have to transition this goal into a PIP amount, right? That is proportionate with your trade account. All right, so if you have a $100 account, you got a $100 account, you can't be trying to say, all right, I'm going to try to cover the water bill and I'm going to do it by trading $1 per pip. Wait a minute now. You only have $100. How are you trying to trade a $100 account to pay the water bill, risking $1 per pip? You go backwards on a pip with a 30 pip stop, on a trade with a 30 pip stop loss. You just lost $30 in one trade out of $100. You just lost 30% of your account in one trade. So you have to be mindful of your trade account size, transition your goal into a PIP amount that's proportionate with your trade account, right? Because 90 pips might take a day or two or three on the average pair, right? On the average pair for a take profit, 90 pips, swing trading, right? Not on gold or any quick moving pair, not on GJ, but the average pair. right? And if you catch it right, if you catch the trade right, you might be blessed enough to get it in one day. In one day. But let's just say you aren't. On a $100 account, $100 account, 10 cents per pip, right? 90 pips is only $9 of profit. 90 pips is only $9 of profit. So your $100 account to take and pay a $75 water bill might not be the goal that you want to set. Not for that size account. Your goal has to be proportionate with your trade account. Right? So maybe your first goal with this $100 account is to take it to $140, 100 to 140 within less than 30 days. That's a 40% jump. That's a 40% jump from 100 to 140 is a 40% jump. Now, did you lose? Did you lose? No, you didn't lose. You grew your account. But the way we look at trading, the way we look and view trading is if we didn't make enough to quit our job tomorrow in 1 month, then guess what? We failed. That's the wrong mentality. It's the wrong mentality. The goal is to make money. If you made $40 in 1 month outside of a job and you did not have to work for it at all, ladies and gentlemen, I call that success. You didn't have to work for it. You proven to yourself that you can make money outside of a job. And here's the thing, you will get the bigger picture when you understand that $40, if you can do $40, then you can do $400 in a month. If you can do $400 in a month, then you can do $4,000 in a month. And guess what? If you can do $4,000 in a month, you can do $40,000 in a month. And if you can do $40,000 in a month, you can do $400,000 in a month. What am I saying? It's all about leverage. That's all it's about. It's about leverage. Leverage your money. Grow your money. That's the focus. The focus is to be profitable consistently. And if you can do that, you are a great trader. If you can make $10 in this market, you are a great trader. You know why? Because you have proven to yourself, I can make money from trading. So I don't care how many times you've lost. If you have won a trade and made more than $10 in your live account, you have proven to yourself that you can be successful. If you can become disciplined, don't be greedy, and control your emotions in the market. The technical side of trading is literally, that's simple. That's simple. Let me prove it to you. I'll prove it to you. Let's prove it to you. Maybe you don't believe it. Maybe you don't believe it. Let me prove it to you. Let's talk about the technical side of trading. I just pulled up EA on the weekly. Let's drop it down to the 4-hour. Ladies and gentlemen, I'm going to prove to you how simple this is. All right, you ready? This right here is going to be circle 1. And then this right here is going to be circle 2. Is this an uptrend or a downtrend, y'all? Is this an uptrend or a downtrend? Let me see. Uptrend. You guys identified that in less than 2 seconds. Okay, so if this is an uptrend, and you know the market moves like this or like this, these are the only two ways the market can move. If you know this, you know the market moves like this. And the whole way on a 4-hour chart, it's going up. What are we struggling for? The whole way, the market is doing this one pattern the whole way up. The entire way up. So we know that these are entry points. Look at this. Over and over. Every time it retraces. Every time it retraces. Let's look at this. Look. How many pips is this? 24 pips in 20 hours. That's 1 day worth of pips. That's 1 day worth of pips. On the retracement. 167 pips in 20 hours. 167 pips in another day off the retracement. 108 pips in 3 days. In 3 days. Right here. 148 pips in 1 day. What are we struggling for? What are we struggling for? You can identify a trend. What's the problem? Here's another thing that I need you guys to understand. Here's another thing I need to understand. I need you to understand two questions. Two questions that you should always ask yourself when you pull up a chart. First two questions you should always ask. Number one, what direction, what direction is the trend moving in? Question number two, what logical reasons and confirmations can I find to get in the trade moving, hold on, to get in the trade moving with the trend? You know the mistake we all make, y'all? Y'all know what we do? You know what we do? You know what we do? This is what we do. Let me show you. Let me get rid of these circles real quick. Let me show y'all exactly what we do. All right, so we'll pull up a chart. We'll pull up a chart and we go to the daily. And we will do this. Okay, here's the high right here. Okay, so we got a reversal area right here. All right. We got a reversal area right here. This is what we'll do. We'll say, okay, it's hit a reversal area. It's on the daily. All right, so when it comes here into this box, we're going to take the sell And we're going to put our stop loss right about here. We're going to put the stop loss right about here. And just because we see a high, a major reversal area right here, we look for sales automatically. We assume just because it comes to this area that we need to take a sell. And look what happens. Look what happens every time. Almost every single time, the market makers know we're looking for the reversal. We're looking for the reversal. So what do? They go higher. They go hit everybody's stop loss because we all have been taught, okay, so there's a major reversal area here. If it came here before in history, then guess what? We should be expecting a sell, right? And look, we have more confirmation over here. Oh, look, we got wicks here. We got wicks here. We got wicks over here. And what do we say? We rationalize. Oh, the last time it came to this area, it dropped. Last time it came to this area, it dropped 1,700 pips over a 2-month period. Last time it came to this area, it dropped another 1,600 pips in a month. Okay, and then the last 2 times it came here, it dropped. All right, so it must be about to do the same thing right here, right? Wrong. We try to find reasons to take the trade the opposite direction, when what we should be doing is finding valid reasons to keep going with the trend unless the market shows us a different reason why we shouldn't. And I'm guilty of it too. I'm guilty of it too. We look for reasons to continue to actually take the reversal when we should be looking for valid reasons to keep going with the trend. So these are the 2 questions that are most important. What direction is the trend moving in? And what logical reasons and confirmations can I find to get in the trade moving with the trend? Everybody's heard the trend is your friend. We all have heard that. Why are we not applying it? The trend is your friend. The trend is your friend, right? So if the trend is our friend, then why don't we just go with the trend until otherwise, until told otherwise, until shown otherwise, until the market gives us a confirmation to not to go with the trend? Then what should we be doing? What should we be doing? Going with the trend. We have yet to see a reason to sell. Reversal area. Continuation. Continuation area. Another continuation area. The market gave us 1, 2, 3, 4, 5 chances to get in for the buy when majority of people are still looking for sells. Market gave us again 1, 2, 3 chances to get in for the buy when everybody else is looking for sells. The market gave us again 1, 2 chances to get in for the buy when everybody else is looking for a sell. And what do we do? What do most people do? They do this. Oh, it's getting exhausted. Look, it's wicking out. Now it's about to sell. Let's take it now. No, we have not had a confirmation to take the sell yet. This is the confirmation to take the sell. Large engulfing candle coming this way, retesting and continuing. If you don't see that, you should not be looking for the reversal. You should be looking for the continuation. What logical reasons and confirmations can I find to get in the trade moving with the trend? Moving with the trend. Moving with the trend. These are the 2 questions that I have at the front of my mind every single time I look at a chart now. I'm no longer looking for reversals only. Now I'm looking for reasons to continue with the trend. I don't care if it is a major reversal area until if it's a major reversal area on the higher time frame, just like it is right here, just like it is right here, until the market shows me that it's tired of moving north, then I'm still moving north. I'm still moving up, bullish. I'm still going for the buys. I'm still going for the buys. Over and over again. Look at these impulse moves. Look how long they were buying. The buyers are controlling the market. Then we get a reverse, and the market makers are still going north. And then we get a reverse. Market makers still going up. Then we get a reverse. Market makers still going up. They still going up. And this is the reversal area right here. And they still going up. So all these people who got in cells, there's millions of people around the world. This used to be me. Millions of people all over the world looking for a sell simply because in market history, the market has told us, oh, it always sells when it gets to this area. Sell, 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 sell. Not taking into account the wick. That means the market moved all the way up here. The market came all the way up here. Let me extend this. Hold up. Let me extend this so y'all can really see it. Look how many times the market makers went above this area. But we try to see, what we do is we try to make the charts look like what we want it to look like to take the trade we want to take, instead of looking what the market is actually showing us. The market showed us over and over again that it can go higher than this area, but we completely ignored that. We're just looking for reasons to justify getting in for the sell that we want. So there's millions of people all over the world who saw the market get to this area, and then put in sells. And what did they do? What did the market makers do? Go higher. So if you would have had the way of thinking that I'm talking about, asking yourself for logical reasons and confirmations why you should continue moving with the trend, then you would have been able to answer that question simply because the market makers haven't shown us a reason not to go with the trend. So what are we going to do? Continue to go with the trend. Continue going with the trend. So now with that mentality, you can see, I just showed y'all like 3 different trades that was over 100 pips in one day. In one day, on one chart, on the so-called slow pair, the AUD. Everybody says AUD is slow. And it still was given 100 pips in one day. So set your goal, trade with a purpose, don't chase the money, go after the pips, and the money will come. And go with the trend. Go with the trend. Go with the trend. And here's the thing, guys. When you see that when you're trying to make a determination as to where you believe the market is going to go, you don't just get in. This is the mistake I used to make. I used to say, okay, it looks like it's going to drop right here. I'm getting in for the sell. That's the mistake. You don't get in based on what you think is going to happen. You get in based on the confirmation of what you think is going to happen. actually happens. You need confirmation. You need confirmation that the market is indeed doing what you want it to do. So if I go back to the chart, all right, so let's use this for an example. We got consolidation all across here, and it was also consolidating down here. All right. So if I make this like this, right, and we're going to take a look at this wick right here. And what do we always do? We're looking for a reason to keep going. Oh, look, it's broken. It's broken the consolidation area. Let's buy. Nope, you were wrong. That's the danger of looking to see what you want to see. Don't look at the market to see what you want to see. Look to the market and listen to what the market is telling you. Look at what the market is telling you. Wait for confirmation of what you believe, is going to happen. So if I say, okay, I see the market come back down here, right? And this is the consolidation zone. All right. So based on history, the market has bounced back and forth between this channel over and over and over again. This channel, from the top of this channel to the bottom of this channel, about 166 pips worth of consolidation. So if I was watching this and I wanted to trade this back up, I'm looking for a buy, because over and over again, look, over and over again. Look at this. Look at all these reasons to continue buying. Look, over and over again. Market gave us reasons. Buy. So what am I expecting when it comes down here? I'm looking for a buy. But listen to what happens. Look at what happens when you don't try to anticipate the market and you become a reaction trader. You react to what the market shows you. Look at what happens if you react and you don't anticipate. Because I used to be the anticipation trader. Oh, it's in the area. Okay, I'm going to get in for the buy, because over and over again, it showed me that it's going to buy over and over again. So it must be about to buy right now, because that's what it's always done, right? And that's what I used to do and lose. But when you adjust your thinking to becoming a reaction trader based on what happens, okay, I'm looking for the buy. I don't see it. It's sold. It's sold. And then the market closed here. And what did it do? Continue selling. It continues selling. So if I would have just reacted based on what the market actually showed me, look at here. I could have ate 74 pips. And watch this. Look at this. It came down, went back up, and continued down. I could have took an entry again right here until the market showed me otherwise. Now, to be fair, the market showed me otherwise right here. Look at this. This right here was my area to sell. I sold. Let's say I protected my profits. It hit my stop loss on the way back up. Okay, cool. But look what it did. It came up, went back down, broke my zone right here. broke my zone right here. It broke it. Retest it. Continue. This was my reason to not keep selling. It gave me a reason. It showed me why. Okay, Charles, we're not selling anymore. Don't get in for the sell. Wait to see what the market wants to do. And then ultimately, it showed us. It showed us exactly what she wanted to do. Eventually, it showed us exactly what she wanted to do. Buy. And until she gave us a reason not to buy, we keep buying. Did she give us a reason not to buy yet? No. So what should we be doing? Buy. Because she didn't give us a reason not to yet. This right here is the new zone. Like I said, that's the new zone. If she does not do this, we're not selling yet. Until she does that, we're not selling. We're going with the trend. What logical reasons and confirmations can I find to get in the trade moving with the trend? That's what you always want to ask yourself. If she didn't give me a reason not to go with the trend, then guess what I'm doing? I'm going with the trend. I'm going with the trend. So you would have gotten in after it broke and closed. Over here, what I would have did, based on this right here, she didn't really break it right here. She didn't break this zone. She retested it and came back down. Right here, this is a break. Let me show you guys what a break is. A break is when the candle closes above the area, but stays above the area. By definition, this isn't even really a break because it came back down. This, let me show you the two candles where this really broke at. The two candles where this would constitute a break, those two right there. It closed above the zone, continued moving forward, and kept going until it came back down. And where does your stop loss go? Below the low. It goes below the low. In my rule of thumb, 15 to 20 pips below the low. And if you would have followed that rule, even right here, with drawdown, when it came back down here, you would have been right. Now, if you're using proper risk management, you don't have to worry about the drawdown. This is why you never risk more than 5% of your account on any one trade or any multiple trades. No more than 5%. If you always do that, the losses, you're not scared to place a trade and go live your life. The only reason you're scared to place a trade and go live your life is because you know you over leverage. You praying, please go the way I want it to go. Please, please go back, go back. You need to go up. Don't go down, go up. You praying that it don't hit your stop loss because you know you over leverage. But if you shift your mentality towards trading, meaning being profitable, not just $1,000 days, not just $500 days, not just $100 trades. You know, I'm successful because I had a $200 day. No, you're successful because you grew your account today. That's the only thing that constitutes success, growing your account, making money, not losing money. I don't care how much it is. If you made $10 a day with 19 trading days in a month, you made $190 from pushing buttons on your phone. $10 a day. What most people do is they'll have the winning trade, hit their goal, and keep trading and give all the money back to the market. So if you say, all right, my goal today is to grow my account by $25. And then you do it, you're done. You're done. Walk away. Let's just do some math, y'all. Let's just do some math. $25, let's just say 19 trading days a month. You just made $475 in a month, just $25 a day. Now, I know it's people on this webinar listening to me right now that are seasoned that can do $25 in their day in their sleep. It's about confidence. It's about victories. If you build your account and you do what you said you were going to do, you hit your goal, be satisfied with what you accomplished and walk away. You grew your account $475 in a month, you are successful. $50 a day, 19 trading days in a month because we're not trading NFP, assuming there's no holidays, $950. Who's mad? Who's upset? $50 a day. Who's upset? Y'all gotta understand. It's about, yes, psychology agreed must be conquered first. Exactly. It's about being profitable. You go into every single trade you take with a goal in mind. So this is why risk management is important. This is why psychology is important. This is why understanding your psychology is important. I got y'all on my TV. This is why it's important. Psychology of trading is important. Don't be greedy, y'all. There's no reason to be. Be profitable. Be profitable. Make money. And if you made $10 in a day, if that was your goal, you are successful. You did what you said you're going to do. If your goal is $25 in a day, guess what? You are successful. You did what you said you're going to do. You know what I'm saying? So I really, really, really wanted to make sure that we had a session like this so I can try to shift some of you guys' mentality toward the market to just be profitable, because the money will come. The money will come. The $1,000 days are going to come if you just remain profitable. That's it. You know what I'm saying? Making what you make in 2 weeks in 1 day is inevitable when you just remain profitable. That's the key. So that's everything, guys. Before I go, make sure you subscribe to this YouTube channel. Make sure you share this with all of your trading friends. And listen, if you're interested in learning how to trade, if you are a trader who trades by yourself, if you're a complete newbie and you want to learn how you can make money from your cell phone, laptop, desktop, computer, or tablet, what you can do is go ahead, head over to my website, smartphonecash.com. smartphonecash.com. I'll put it on the screen so you can know exactly where to go. Make sure you follow me on my Facebook, Instagram, YouTube, and Lady Kingdom Cash as well, my better half. Follow her as well, and reach out to me if you have any questions. I'll be more than happy to help. And like I said, if you want to get personal mentorship, personal help from me, make sure you reach out to me on any of my social media tags, and I'll be sure to help you out. All right, everybody be blessed. Peace.